The recession model is flashing 9 warning signals right now. The yield curve, just uninverted, unemployment spiked. Job creation basically stalled. Markets are completely ignoring all of it. Every one of these signals has historically preceded recessions. And the real estate cycle says we're due for a crash soon. But what if we're wrong? What if this time really is different? Hey, welcome back to The Recessionist. I'm Tom. And look, I've been calling this recession for months. The model's been ahead of the curve on Bitcoin's crash, the jobs overcount, the consumer pullback. But if you're going to be bearish, you need to understand the bull case, not to dismiss it, but to know exactly what would have to happen for it to work. So let's steelman the soft landing scenario, because intellectual honesty matters more than being right. And honestly, the bears could be walking into a trap here. The setup feels almost too obvious. When everyone's expecting something in markets, that's usually when the opposite happens. So let me show you exactly how the soft landing scenario could work, why smart money might be betting on it, and what it would mean if the recession signals are giving us the mother of all false alarms. So let me break down what's actually happening behind the scenes. The recession model sits at 67 out of 100. That's pre-recession territory. Up from last week as market fear spiked hard, 9 warning signals are flashing red. That sounds terrifying until you dig into the details. Here's what nobody's talking about. Not all recession signals are created equal. Some have perfect track records going back decades. Others have been crying wolf for years. The leading economic index has been negative for years straight. Manufacturing has been in contraction territory for over a year. Consumer confidence has been in the gutter while people keep spending like nothing's wrong. And that difference matters because for a soft landing to work, you don't need every signal to be wrong. You just need the right ones to be wrong, the tier 1 signals with perfect historical records. And that's where it gets interesting, because there's actually a case that the most reliable indicators might be broken this time, not permanently, but broken enough to give false positives during what could be the most unusual economic cycle in decades. Let me walk you through the hierarchy of recession signals, because this is where the soft landing case gets compelling. There are basically 3 tiers. Tier 1, historically bulletproof. Perfect or near perfect track records. The Somme rule sits at the top. It's triggered during every single recession since 1950. No false positives, no missed calls. Perfect right now. It's sitting just below the trigger point. But unemployment hit dangerous levels last month, and the trend is wrong. But here's the thing. Claudia Somme herself, the economist who created the rule, has been saying this cycle might be different. Immigration. We added millions of people to the workforce recently. That's not demand-side unemployment. That's supply-side labor expansion. Completely different dynamic. The yield curve uninverted is the other tier 1 signal. It's preceded every recession since 1960, but, and this is crucial, it also happens during successful soft landings when the Fed normalizes rates after beating inflation. The mid-90s, the yield curve uninverted, everyone panicked, and then we got years more of Goldilocks economy. Could be happening again. Tier 2 signals are strong but imperfect. Job creation has collapsed from solid numbers to barely anything. That's stall speed. The divergence between market euphoria and labor stress is maxed out, but job creation was also weak multiple times without triggering recessions. Labor markets can stay in stall speed for months if productivity holds up. Tier 3 signals are the boy who cried wolf category, leading economic index declining for years. Manufacturing in contraction, consumer sentiment in the basement while retail sales keep growing. These signals have been wrong so often lately that ignoring them might be the smart play. So here's the core gamble for a soft landing. You don't need the tier 3 signals to be wrong. Some already have been for years. You need the tier 1 signals to misfire both the Somme rule and the yield curve simultaneously. For the first time in 60 years, that sounds impossible until you look at what's actually different this time. Immigration is the big one. We've never had labor supply expand this fast outside of wartime. The Somme rule assumes unemployment rises because of layoffs, demand destruction. But what if unemployment rises because of supply expansion? New workers entering faster than job creation? That's not recessionary. That's actually healthy long-term because it gives the Fed room to cut rates without triggering inflation. The yield curve story is more subtle. Historically, when the curve uninverts, it means the Fed is cutting rates because recession is imminent. Bond markets are pricing in economic weakness, but this time the uninversion happened because long rates rose, not because short rates fell. The 10-year jumped dramatically in months. That's not recession pricing, that's growth and inflation expectations rising, completely different signal. The Fed might not even need to cut rates aggressively if the economy stays strong. And here's the kicker. Corporate balance sheets are historically strong. Cash levels are high. Debt-to-equity ratios are manageable. Even if we get a slowdown, companies aren't leveraged to the gills like previous cycles. They can weather weakness without mass layoffs. But then there's the elephant in the room that soft landing believers have to explain. The 18-year real estate cycle. Every major recession, real estate led. The pattern says we're due. Some economists swear by this thing. Phil Anderson built his whole career on it. The argument is that generational memory fades every generation or so. People who lived through the last real estate crash retire or forget. Lending standards loosen, speculation builds, prices disconnect from fundamentals, and boom, crash right on schedule, the pattern held through multiple recessions and crises. But here's the counter-argument, and it's compelling. We're not in a real estate bubble this time. We're in a real estate shortage. Housing inventory is at historic lows. Construction has underbuilt demand for a decade. Mortgage rates doubled and prices barely budged because supply is so tight. That's not bubble behavior. That's structural undersupply. Plus, fixed mortgages create lock-in effects that didn't exist in previous cycles. People with cheap mortgages aren't moving unless they have to. That reduces supply further. The cycle may be broken or just extended, maybe instead of the traditional pattern. It's longer this time because of monetary policy intervention and structural changes. For a soft landing, this pattern would need to not repeat, which is entirely possible. Demographics are different, monetary policy is different, the global economy is more complex, but dismissing a pattern that's held for over a century. That takes conviction or hubris. So, let me give you 3 ways this plays out over the next year and a half, with specific probabilities. Scenario 1, soft landing works. 30% probability, the Fed threaded the needle perfectly, immigration explains the unemployment spike, which peaks and then declines as job creation rebounds. The labor market rebalances without triggering mass layoffs. Seasonal adjustments that made job numbers look terrible get revised higher. The yield curve steepening is just policy normalization, not recession warning. Inflation falls without breaking the labor market. The real estate cycle is broken by modern monetary policy tools and structural changes in housing markets. Corporate earnings grow as margins expand from productivity gains. Markets were right to ignore the signals. Soft landing achieved. That's the bull case. Scenario 2, rolling recession. 45% probability we get sector-by-sector weakness instead of broad collapse. Manufacturing stays in contraction, but services hold up. Regional stress in some areas, but other metros with tech and finance stay strong. Unemployment rises, but slowly. The model stays elevated, but never fully triggers. Corporate earnings are flat, but no collapse. Some sectors struggle while tech and healthcare stay resilient. The recession is mild, long, and uneven. That's muddle through. Most likely scenario. Scenario 3, the signals are right. 25% probability labor stress builds into broader weakness. Corporate earnings disappoint significantly as margins compress. Credit conditions tighten as regional banks face commercial real estate losses. The Fed is stuck between persistent inflation and growth concerns. We get the recession the model has been predicting. Traditional recession, less likely but highest impact. So what does this mean for your actual money? This isn't academic. If you're betting on the soft landing, you're making a specific wager. You're betting that Tier 1 recession signals can misfire simultaneously for the first time in decades. Maybe they can. The immigration factor is genuinely unprecedented. Fed credibility is higher than it's been since the Volcker era. Corporate balance sheets are strong, consumer debt-to-income ratios are manageable. There's a real case here, but if you're wrong, you lose a huge chunk in a matter of weeks when recession actually hits. Look at what happened in recent crashes. When recession signals finally trigger, markets don't give you time to react. The decline is fast and brutal. If you're positioned defensively like I am, significant cash, reduced equity exposure, overweight defensive sectors, you're making the opposite bet. If soft landing works, you underperform by a modest amount. You miss some upside. But if recession hits, you preserve capital while others get crushed. The risk-reward is asymmetric. The downside protection matters more than the upside capture when you're this late in the cycle. And here's the thing about late cycle investing. It's not about being right. It's about not being catastrophically wrong. Being defensive cost you months of gains, but staying aggressive cost you years of losses. The math is clear, but there's another angle here. What if you could position for both scenarios? Cash for safety, quality large caps that can weather a slowdown, defensive sectors like utilities and consumer staples, contrarian plays that benefit from volatility. That's not market timing, that's scenario planning. And look, nobody wants to be wrong about this stuff. I get messages from people every day asking if they should sell everything, if they should buy more, if they should change their whole strategy. Being bearish when things work out fine makes you look like a pessimist. People stop listening, your credibility takes a hit. But being unprepared when things fall apart, that's how people lose decades of savings, that's how retirements get delayed, that's how families get hurt. The goal isn't to be right, it's to be positioned for what actually happens, and what actually happens is usually some version of what we expect, just with different timing and different magnitude. Bottom line, the model reads 67 out of 100. Pre-recession phase, 9 warning signals are flashing. For a soft landing to work, historically reliable indicators would need to misfire simultaneously. It's possible. Immigration dynamics are unprecedented. Fed credibility is real. Corporate balance sheets are strong, but the base case remains recession within the forecast window. I remain defensive. Significant cash, equity underweight, overweight, utilities, healthcare, and consumer staples. Same positioning since launch, and it's outperformed the market significantly with much less volatility. If you want to track this stuff in real time, I built a full dashboard at recessionistpro.com. Indicators, sector analysis, risk metrics, forecast, $20 a month. No ads, no affiliate links, just data. Here's exactly what to watch over the next few months. If unemployment stays manageable and job creation rebounds for consecutive months, the soft landing case gets significantly stronger, and I'll reassess the defensive positioning. If the SOM rule stays below the trigger and the yield curve steepens without credit stress, that's pro-soft landing. But if unemployment breaks higher or job creation stays in stall speed, the model likely moves above 70. Credit spreads widening would be another red flag. We'll know which scenario we're in by summer. The data will decide.